Hello again. I'm Tom Willemain. I'm one of the co-founders of Smart Software and the Senior Vice President of Research. This is another in our series of Chalk Talks about inventory and forecasting. So today we're going to talk about the fourth of the major approaches to managing inventory. And we're changing the focus from the previous three, which were quite reactive. And this fourth, which is called forecast-based inventory management, it's also known as MRP logic. This is a more forward planning type of methodology. And the scenario we're going to look at is managing a finished good, which is assembled from three components. A fairly simple but standard kind of situation. And our agenda today has four parts. We'll start by looking at some very simple and then less simple models of inventory dynamics. Second part will be to think about how we determine how much to order and when to make the order. The third part of the agenda is to understand where does lead time come from? How do we calculate lead time? And the fourth part is where does safety stock come from? How do we calculate safety stock? So that's our scenario, that's our topic, and that's our agenda. So let's begin by making some simple pictures of inventory dynamics. One of the best statisticians of the 20th century was a man named George Box, and George Box had a famous saying. He said, "All models are wrong, some are useful." We're going to show some wrong models here. Some are less wrong than others and more useful than others, but they'll give us a feel for the dynamics. So the first picture is the one you might see in the first pages of a chapter on inventory management in a basic class. And we'll show a graph against time. So we'll mark this as day. And this will be the quantity of on-hand inventory. And the simplest of all model is this. Around Smart Software, we call this the sawtooth for obvious reasons. And it just says in a very idealized world, you have inventory, demand comes down, your inventory drops to zero, but never goes below zero. There's never a stock out in this candy land. And then you have replenishment that comes just in time. It puts you back up to here. And this is sort of the starting point for a lot of basic inventory analysis. And it's a good place to start. But it makes this assumption that every time you get down to the very edge of a stockout, you're rescued by replenishment. And that's a little bit of a fantasy. So what people do is they move zero down to here, and they have this line, which is called safety stock. And we try to have the inventory drop until we get to this point rather than to zero. So that if realistic things happen, if for instance here we happen to go down to that point and then we replenish, we still haven't had a stock out. That's the whole point of safety stock, to give a little buffer, a margin of error in the forecast. So this is a slightly more realistic model of the inventory dynamics. The real dynamics don't really look like this. It doesn't look like a sawtooth. It actually looks like a staircase. So we might have our safety stock level here. We'll call that SS. And our inventory will be moving like this. There'll be periods between demands, and then there'll be demands coming in, and we may go negative, and then we get replenishments, and we have something more like a series of staircases rather than sawtooths. But the point is that zero is here, and we're trying to not go negative. So those are simple models of the dynamics. A more complicated model, even starting from this simple model, is to put in our safety stock and allow for the fact that the demand is not necessarily the same from week to week. Some weeks may be busier and some weeks may be quieter. So the sawtooth, if we go back to the sawtooth model, might start like this, but then the next week there might be low demand, so inventory drops slowly, and then there might be very rapid demand, so inventory drops quickly. So there are many ways that we can depict this, but the basic dynamics is we're going up and coming down, we're really going in discrete steps most of the time, and we want to have a buffer above zero so that we can avoid stockouts. And of course we want to talk about how you calculate this safety stock and when we ask for replenishment and how much we should ask for. So that will be the next thing on our agenda. So let's think now about the next piece of the agenda, which is deciding when to order and how much to order. And we'll go back to the simplest sawtooth. So we have the time plot. Here is day, and here is the on-hand inventory, and here is the safety stock. And we'll imagine that we've been coming along in our sawtooth, and think about now what happens during the period of the sawtooth. There'll be a moment, let's call it right here, which is the time you have your planning meeting. So here's the planning meeting, and what you have to do is decide to make a forecast and see when you're expecting to hit the safety stock. So at this point you would use your forecasting software to predict out the future demand, which you can easily translate into the future safety stock, because if each demand that comes in, you're going to have a drop in the inventory. So the forecast, this dotted line, would come out and hit the safety stock at some future time. So we'll call that where you hit the safety stock. So at that point, if we're treating safety stock as the minimum below which we don't want to go, we have to go back and make sure a replenishment comes in to move us back above safety stock. So when we hit the safety stock, for that replenishment to come in, we have to order far enough ahead of time that those three components can be available to us to assemble into the finished good. So we will walk back by a lead time to another time here, which is when we would order the components. So we predict when we'll hit the safety stock, we walk back to find when we should order, which would be right here. And at that point, our inventory will have hit this level. We're going to expect a further drop in the inventory during the time when we're waiting for the replenishment. So we have this much inventory to make up. So this gap is how much we should order. This gap between here and the safety stock. So that when the lead time is expired, we'll be back up here and we can continue our sawtooth. So the lead time is working back from the hitting time, which gives us the ordering time, and then we know how much we should order. And actually it's the ERP system that is triggering the order and calling for the components. So that's the way the sawtooth sustains itself over time. It starts with a forward planning meeting, works off a forecast, and then that calculation, knowing the lead time and knowing where the safety stock is, tells us how much we should order, and it perpetuates the sawtooth. Now, if you're very alert, you will notice that I drew this to put us back to a smaller gap above the safety stock than we had previously. And there's a subtlety here that actually happened accidentally in the way I was drawing on the board, but it's an interesting point. The slope of this line is indicating something about the level of demand. And if you look closely, the period from here to here was so much and so much, and now we have a longer period and a flatter slope. That indicates that I've drawn a scenario where the demand has started to decrease, that the demand is lower. And that's why we have the forecast. The forecast would be presumably tracking the evolution of demand and taking that into account. It would see the downward trend, and it would have its projection out is flatter than these previous steeper lines. So this interval until we hit, this was the interval before, it was about the same here, and all of a sudden this one is longer. That means that we're reacting through a good forecast to the drop in demand, and that also means we don't have to carry as much stock to keep ourselves above the safety stock because it's dropping slower. So if you caught the fact that the peaks used to be here and now it's here, give yourself an A for alertness. So the next piece will be, how do we figure out the lead time? And after that, how do we figure out the safety stock? So now we've seen the first part of the agenda, which was basically the sawtooth and its more realistic variants, and that describes the dynamics of the on-hand inventory. We've just seen the way we use forecasts to plan ahead to see when we have to order and how much, with the aim of not dropping below the safety stock. Now, in life, we're very likely to drop below the safety stock, but the whole point of the safety stock is to have enough of a cushion that we avoid the real problem, which is going negative and not having sufficient inventory to meet the customer demand. Now, we've introduced the notion of a lead time as important in that calculation. We start with the forecast, then work in the lead time and figure out when to order and how much to order. Where's the lead time come from? Well, in this particular case, our scenario is that we have a finished good that has to be assembled from 3 components, A, B, and C, we'll call them. Well, think back to our problem of coming down with our forecast, hitting the safety stock, and then we said we work back by lead time, and that goes up to when we should order. So this is when we order, and this gap is the lead time. Where does the lead time come from? Well, if there are 3 components, we have to make sure that all 3 are available when we need them. And there's no guarantee that they will all be readily available. So component A may require that we go back to here. If we order then, the A part will be ready. But component B might take longer to be available, and component C may take even longer. So it's really the slowest of these components, the one with the longest individual lead time, which governs when we order. If they all happen to be available quickly and uniformly, they all take, say, 5 days to be available, then that's our lead time. But if one of them takes longer, then that's the one that's slowing the whole train down, and that's the one that governs the lead time. If we happen to have available quantities of the components, and they're all basically on the shelf, A is there, B is there, and C is there, and they're going to be available in the quantities we need, if we've got just a beaucoup A's, beaucoup B's, and beaucoup C's, then we're all set. We can basically have a lead time of 1 day. But that doesn't always happen, especially if a component is not in stock and has to be special ordered from a supplier who says, yes, I could get it to you in 14 days like always. So that supplier is governing the calculation of the lead time. So obviously there's a premium on making sure that you have available inventory of the components so that you can have very quick lead times and therefore very small increments of inventory, and you can live very close to the safety stock at that point because you're running very efficiently. But if there's any delays, those push up the inventory and you pay costs in terms of higher investment in stock in a warehouse someplace or in the aisles of your factory. Now the final point of our agenda is, where does safety stock come from? How do we figure out why we have it and what it should be? So I've drawn a picture of our ideal scenario and then something that's much more dangerous. So here we are at the point where we make our forecast. The dotted line shows the forecast. We have a lead time. We know when to order. We know how much to order. And we expect that the future will be the inventory dropping through this dotted line. Then the replenishment comes in and continues. And we're always above the safety stock. So we're in a comfortable place. But the red line shows what happens if our forecast is wrong. Perhaps someone got ambitious and did a marketing campaign and suddenly there is a higher demand for this finished good than we expected in our forecast. That means, following the red line, that our actual on-hand inventory is going to be much lower than we expected. But we've set the wheels in motion for the ERP system to order this much at this time and will come in at this time. What's actually happening is our inventory on hand is depleting faster than we thought. This order will actually come in here and reverse that trend temporarily and give us a little bit of a bump, and then we're going down according to the new higher level of demand. So what the safety stock has done for us is it has let us go below our comfortable level, but it has kept us above zero. It has avoided or postponed a stock out. And that's why we have the safety stock. Because we're thinking that our best guess is the dotted line forecast, but we recognize that life may give us the red line forecast. And as a result, the safety stock has prevented a stock out and has delayed a reckoning. And presumably we could then make a new forecast which would take account of the new level of demand and try to recover. There may be in our future a temporary stock out, but we have a plan that will react to that because the new forecast will have better information about demand. So you can see that demand forecast accuracy is critical to making sure we avoid stockouts. And as adults, you realize that it's not possible to always anticipate future demand perfectly. So there's always a chance of stockouts, but the safety stock minimizes that chance. Now, how would we actually set the safety stock? Well, we would take account not only of what the expected forecast is, but we'd go up a level and we'd say, what is the margin of error in the forecast? And understanding the uncertainty of the forecast is the basis for looking at safety stock. So now we'll make a different kind of picture. We will show a picture of what we think the cumulative demand will be over our lead time. So now we have a different kind of plot. We have cumulative demand, and we realize that that could be anything from 0 to some big number. And what we're going to show is all the possibilities, and we'll express this in terms of probabilities now. So now probability theory comes into the demand planning process. And we have an expected forecast, that's this dotted line, and it says we think that there'll be a certain total demand over the lead time. So this is the expected forecast. And usually the one we're planning from is the one that's most likely. So this will have a high probability, but it won't be a certainty. And so we could imagine a process where we think about other possibilities, where other values of demand also have some chance of occurring. And that would be a picture that looks something like this. The heights of these would come from an analysis of the variation in demand over time. Because the demand is never rock solid, it's always bubbling up and down, and that creates the uncertainty, and it gets compounded when you add together uncertain demands over a lead time. So you have this picture of the possible values of cumulative lead time. And conceptually, the way we work with that is we draw a line up here above the expected forecast. And we say, we will try to set the safety stock at a level which will cover most of the contingencies. Maybe this red line covers 90% of the possible ways the demand could play out. And the gap between this 90, so let's say the 90th percentile, and the expected forecast, this is the safety stock. That's how we calculate a safety stock. We say we're going to accept a certain risk of stocking out, and we're going to calculate the difference between that risk level in the cumulative demand and the expected forecast, and we're going to build in this buffer. And that means that all of these scenarios, the other 10%, would actually create stockouts. So if we don't like a 10% risk of stockout, then we move this level up. We expand the safety stock, a bigger buffer, and maybe now the remaining is just, say, a 5% chance of a stockout here. So we can calculate ahead of time, based on our risk preferences, what it is that we want to use as a safety stock. And we use that for setting the safety stock level. It's a separate calculation involving the risk that the company wants to take of not having this finished good available when it's demanded. Offsetting that will be other cost consequences, because a bigger safety stock keeps us farther from a zero inventory, which means we have to invest more of our cash in the inventory, and we have more on hand, so we have larger holding costs, but we also have lower shortage costs. So we're again on a kind of universal trade-off curve between the cost of managing the inventory on one hand and the availability of the product to customers on the other. The analysis will tell us what the shape of that cost curve is, the trade-off curve. And then management has to decide on where's a tolerable position to be at this point in the company's operations, what risk of stockout are we willing to accept, and what operating costs are we also willing to accept. And they find that equilibrium point, at least for a quarter, for instance, and arrange for the ERP system to make that happen.